Okay, let's just jump right in. Welcome. I am absolutely thrilled to have you here as a new client for your very first financial consultation. Today, we are going to talk about something incredibly exciting, and that is earning passive income just by owning a tiny piece of massive global companies. I mean, imagine owning a literal slice of Coca-Cola or Apple. When those companies make billions of dollars in profit, wouldn't it be great if they shared some of that cash directly with you? Well, they actually do. But before you start spending that money, there's one person who always wants a cut first, and you know who it is, Uncle Sam. So in today's Explainer, we're going to look closely at exactly how that money is taxed, and more importantly, how you can strategically keep way more of it in your own pocket. So here's our game plan for today's Explainer. 1. What is a dividend? 2. Two types of dividend taxes. 3. Dividend math step by step. 4. Qualifying for lower rates. 5. The dividend tax challenge. And 6. Building long-term wealth. Okay, let's dive into this. Section 1. What exactly is a dividend? When a company actually turns a profit, they basically have two choices. They can reinvest that money back into the business to help it grow, which, is what younger growth companies usually do. Or they can reward their shareholders, the people who actually own their stock, by paying them a portion of those profits. And that payment? That is a dividend. You'll typically see these paid out by large, stable, mature businesses like McDonald's, utility companies, or household names like Johnson & Johnson. They've got the extra cash on hand, and they use it to reward you just for holding their stock. Think of it like this. If you own 10 shares of a stock, and that company decides to pay a dividend of $2 per share, you're going to receive $20. You didn't have to sell your stock to get that money. You didn't have to clock in for a summer job to earn it. It's simply a reward for being an owner. This is true passive income. Literally money you earn while you sleep. But think of dividend taxation like a giant toll booth on the highway to wealth. Before you can take that money home, you got to pay the toll to Uncle Sam. All right, moving right along. Section 2. Two types of dividend taxes. So Uncle Sam essentially puts your dividends into one of two buckets. On one side, we have ordinary dividends, which are sometimes called non-qualified dividends. If you get one of these, the government taxes it just like a paycheck from your day job. It follows your regular income tax brackets, which can be quite high, anywhere from 10% to 22%, 24%, or even higher. Now, on the other side, we have qualified dividends. These are the good kind, the golden ticket. These are taxed similarly to long-term capital gains, meaning they get special, significantly lower tax rates. Depending on your total overall income, qualified dividends are taxed at just 0%, 15%, or 20%. So the crucial point is this. When we're sitting down and selecting stocks for your portfolio, tax efficiency absolutely matters. You always want your dividends to fall into that qualified bucket because it directly translates to you keeping a much larger piece of the pie. Every single dollar you save on taxes is another dollar you can reinvest to grow your wealth. Let's look at the numbers. Section 3. Dividend math step by step. Let's take a client of mine. Let's call her Maria. Maria owns a stock that pays her $200 in qualified dividends. Now, because her total income puts her in a specific range, her tax rate for these qualified dividends is a nice low 15%. So step 1, we identify the $200. Step 2, we convert her 15% rate to a decimal, which is 0.15. Step 3, we multiply the 200 by 0.15, and that gives us $30. That $30 is the tax bill she owes Uncle Sam. So step 4, out of her initial $200, Maria gets to keep a very solid $170 right in her pocket. Now let's contrast Maria with another investor, Jordan. Jordan receives $500, but his are ordinary dividends. Because these are taxed just like regular income from a job, his rate is his standard income tax bracket. Let's say 22%. We follow those exact same steps. We take his $500 and multiply it by 0.22. That equals a pretty hefty $110 in taxes. After paying that tax bill, Jordan keeps $390. Notice how a much larger bite was taken out of Jordan's payout just because of the type of dividend he received. Ouch. And this brilliantly illustrates the real-world impact. Imagine two investors, Alex and Sam. They both earn the exact same gross amount of $1,000 in dividends. But Alex's are qualified at a 15% rate, so Alex owes $150 and keeps $850. Sam's are ordinary at a 22% rate, so Sam owes $220 and keeps only $780. Alex literally walks away with $70 more entirely because of the dividends tax classification. Which brings us to Section 4, qualifying for those lower rates. So, the IRS actually has some technical requirements you have to meet to get that qualified status. First is the holding period. You can't just buy a stock the day before it pays a dividend and then dump it the day after. You must hold the stock for more than 60 days during a specific 121-day window around the dividend payment date. Second is the issuer status. The dividend has to be paid by U.S. corporation or a qualified foreign corporation. And finally, the rules specifically exclude certain types of investments, like real estate investment trusts or REITs and master limited partnerships. Dividends from those guys are almost always taxed as ordinary income. Now, you might be wondering, well, why does the government even care? Why the 60-day holding period? It's all about strategic incentives. The government wants to encourage people to actually invest in businesses for the long haul, to provide stable capital to the market. By offering lower tax rates for those who hold onto their shares, taxing them like long-term capital gains rather than quick, ordinary income, they reward patient investors who are actually helping companies grow over time. Let's see how you do with this. Section 5. The Dividend Tax Challenge. Okay, quick client knowledge check. Imagine you earn $300 in dividends, and you are sitting at that favorable 15% qualified tax rate. Take just a second to mentally calculate 15% of $300, and then subtract that from your total. How much do you actually get to keep? Got a number in your head? The answer is $255. 15% of 300 is 45. So $45 goes to Uncle Sam, and a wonderful $255 stays right in your wallet. Great job. Let's try one more to really bring this home. Problem C. You earn $750 in qualified dividends, but this time, because of your total income level, you qualify for the lowest possible bracket, the 0% tax rate. How much do you keep? Boom! The answer is exactly $750. At a 0% rate, you pay exactly $0 in taxes. You keep every single penny. This scenario really just proves the immense value of tax optimization. If those were ordinary dividends, you'd be handing a significant chunk back. But because they are qualified and you're in that 0% bracket, your passive income is completely tax-free. No way around it. That is just a beautiful thing. Let's move to and see how this builds. Section 6. Building long-term wealth. Understanding this isn't just about passing a tax quiz, it's about making really smart, tax-efficient stock selections for the future. Knowing the difference between ordinary and qualified dividends allows us to be highly strategic. When you legally keep more money in your pocket, your passive income streams grow so much faster. That compounding effect accelerates your retirement planning and helps build lasting wealth. Consistent dividend investing, paired with smart tax planning, is absolutely one of the most reliable wealth-building strategies out there. So as we wrap up our first consultation in this explainer, I have a little call to action for you. I want you to start thinking like an investor today. Which famous dividend-paying company will you research for your own portfolio? Look up Microsoft, PepsiCo, or maybe Coca-Cola. Find out their current dividend per share and exactly how often they pay it out. Learning to research these opportunities is your very next step to building true tax-efficient wealth. Because at the end of the day, it's not just about how much money you make, it is about how much of it you actually get to keep. So, who are you going to research first?